Only 35% of landlords say their rental properties are profitable year after year, according to the National Apartment Association's study of over 16,000 apartment units. The average landlord makes $2,007 per rental unit per year. In today's market, investment property mortgage rates are sitting at 7.5% or higher. The average gross rental yield in the United States stands at 6.56%. Now, I have all the data needed. Here is the full script. You are borrowing money at 7.5% to earn 6.5%. The bank already ran those numbers. The question is whether you did. And I am not talking about some edge case in a bad market. I am talking about the median American rental property. Bought today, financed today, rented at market rate today. The math is upside down, and it has been for longer than most people want to admit. There is a reason only 35% of landlords consistently turn a profit on their rentals. There is a reason 65% do not. Today, I'm going to show you exactly where the money goes, why the standard pitch for rental property breaks down in the current environment, and what you actually need to know before you sign a mortgage on someone else's house. Stay with me, because in about 8 minutes, I am going to show you a number that will change the way you look at every real estate pitch you have ever heard. There's a story I want to tell you first. A guy named Marcus, 42 years old, project manager in Jacksonville, smart guy, does his research. In 2022, Marcus bought a $390,000 single-family rental. It had a 3-car garage, it was in a good school district, and the broker ran him numbers that showed positive cash flow from day one. Marcus was going to be a landlord. He was going to have passive income. He was going to be his own bank. We're going to check in on Marcus throughout this video because his story is not unusual. It is closer to the rule than the exception. The thesis here is simple. Rental property, as a wealth-building vehicle, has been sold to the American middle class based on a set of numbers that stopped being true around the time that interest rates stopped being zero. The old playbook: buy a house, rent it for more than the mortgage, collect the spread, requires a specific set of conditions: cheap debt, rising rents, low vacancy, low costs. We currently have none of those 4 things in most markets. What we have instead is a market that rewards the illusion of passive income while systematically destroying the actual returns of the people who bought in. I am going to walk you through 4 ways that happens, each one worse than the last. But first, the central metaphor you are going to need to understand everything that follows. Everyone who has ever considered buying a rental property has had the same fantasy, the vending machine fantasy. You buy the machine, you put it somewhere with foot traffic, people drop money in, you collect the money, you never have to think about it. Passive income, financial freedom, early retirement. Here is the reality. A rental property is a vending machine that calls you at 2 in the morning because the compressor died, that you are legally required in most states to fix within 24 to 48 hours or face fines. That sometimes the person using the machine stops putting money in, and the law says you have to keep letting them use it for months while you figure out how to get them out. That every few years needs a complete internal overhaul you did not budget for. And that the entire time you own it, you are paying a bank $800 a month more than the machine generates, hoping that eventually someone will want to buy the machine from you at a higher price than you paid. That is the broken vending machine. Remember it, because it comes back. Now, in a few minutes, I am going to show you the side of the exit math that the real estate gurus never put in their YouTube thumbnails. But first, here is why the entry math is already broken in 2026, in a way that most people have not fully processed. The 1% rule is dead. If you have spent any time in real estate circles, you know the 1% rule, the idea that a property should rent for at least 1% of its purchase price per month, so a $300,000 house should rent for $3,000 a month. That number was the bare minimum that historically made positive cash flow possible after financing. And today, in most growing American markets, you are lucky to find 0.6 to 0.8%. On a $415,000 house, which is roughly the national median right now, according to the National Association of Realtors, 0.7% means $2,009. $100 per month in rent. That is, if you can find a tenant at that rate. The national median rent is actually sitting around $1,445, though single-family homes in the mid-400s skew higher. Let's be generous. Let's say you get $2,500 per month. Now, let's look at the financing side. As of early June 2026, the 30-year fixed rate on a primary residence runs about 6.5%. Investment properties carry a premium of roughly 1 to 1.5 percentage points because lenders consider them higher risk if your tenant stops paying rent and you default. You are going to prioritize your own home. So your investment property mortgage is sitting at around 7.5% on a $332,000 loan that is 80% of a $415,000 house. Your monthly payment is $2,323. That is just the mortgage every month before you pay a single other cost. $2,500 in rent, $2,323 in mortgage. You are left with $177 per month before expenses. And this is where the broken vending machine starts making the noise it makes. The industry rule of thumb, one that is backed by enough data that it is taught in property management certification courses, is the 50% rule. Roughly half of your gross rent will disappear into operating expenses before you even see the mortgage line. Property taxes, landlord insurance, maintenance, vacancies, accounting. The rule of thumb exists because it has been validated over hundreds of thousands of properties over decades of data. Half gone. On our $2,500 rental, that is $1,250 in operating expenses per month, $15,000 per year. So let's run the actual math. $2,500 in rent minus $1,250 in operating costs minus $2,323 in mortgage. You are at negative $1,073 per month, every month. You are not a landlord. You are an unpaid property manager who writes a $1,000 check to the bank every 30 days. And Marcus? By the time 2023 arrived, Marcus was 6 months into his rental and his tenant had started paying late. Then, not at all. The eviction process in Florida took him 11 weeks and cost him, all in lost rent, legal fees, property turnover, just over $8,000. One eviction, $8,000. Gone. Stay with me, because we have not even gotten to the part that makes this whole thing worse. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. Let's build out the actual cost structure of that $415,000 rental, not the fantasy version, the one with the real numbers. Property taxes first. The median effective property tax rate in the United States runs about 1.1% of assessed value. On a $415,000 house, that is $4,565 per year. And that number is moving. According to data from Doorloop covering 2024, property taxes were the top cost increase landlords reported, with 60% experiencing hikes, and half of those faced increases of more than 6% in a single year. Landlord insurance, not homeowners insurance, landlord insurance. According to the Insurance Information Institute, landlord policies cost about 25% more than a standard homeowner's policy because landlords carry more liability exposure. If a tenant slips on ice on your property, you own that lawsuit. Plan for roughly $1,200 to $2,000 per year, depending on location. Maintenance. The commonly cited guideline is 1 to 2% of property value per year. On a $415,000 property, that is $4,150 to $8,300 per year, just in routine maintenance. And that is if nothing major breaks. A roof replacement runs $8,000 to $15,000. HVAC failure, $500 to $3,000. Plumbing emergency, $250 to $1,000. These are not hypotheticals. These are the items that show up on every landlord's balance sheet sooner or later. Maintenance costs across the industry increased 12% in 2024 alone. Vacancy. The national rental vacancy rate hit 7.3% in the first quarter of 2026, according to the US Census Bureau. That is almost a full month per year where you are carrying every cost with zero income. On a $2,500 rent, A 7% vacancy assumption strips out $2,100 per year from your gross income before you start. Accounting and legal. The IRS treats rental income as ordinary income, not capital gains. You need a professional to navigate depreciation schedules, Schedule E filings, and all the compliance that comes with being a landlord. Expect $250 to $1,000 per year just for the accountant. And now, the cost that nobody puts in their spreadsheet, your time. Real Property Management ran a calculator on this. The average self-managing landlord spends 47.5 hours per year on leasing, finding tenants, showing the property, running background checks, drafting leases, and another 46.6 hours on management. Call it 94 hours per property per year. 94 hours. That is more than 2 full work weeks every year at a job that pays you varying amounts of stress and the occasional middle of the night maintenance call. If you value that time at $50 an hour, which is conservative for a professional, considering a real estate investment that is $4,700 per year in unaccounted labor. The same National Apartment Association study that covers 16,000 plus rental units found that the average landlord makes $2,007 of net operating income per unit per year. $2,007. That is $167 per month before taxes, and before you account for a single hour of your own time. You think the problem is finding the right property. Actually, the problem is that the math structurally does not work for most people in the current environment, in most markets, financed at current rates. Finding the right property is the surface problem. The interest rate yield inversion is the real problem, the broken vending machine. Here is the part that is genuinely interesting, and the part I never see run honestly in real estate content. You have $83,000 sitting there. That is your down payment on the $415,000 rental. Let's say instead of the rental, you put that $83,000 into an S&P 500 index fund and walked away. From 1992 to 2024, the S&P 500 generated an average annual return of 10.39%. Over 10 years, at that rate, $83,000 becomes $223,000. You did nothing. You made no decisions after day one. Nobody called you about a busted water heater. Now compare that to the rental scenario. You invested $83,000 as a down payment. You are losing approximately $1,000 per month in negative cash flow, and over 10 years, you have pumped an additional $120,000 into the property just to service the gap between rent and true costs. You are also counting on appreciation to bail you out. And here's the problem with that. In 2025, the median home price grew 1.7% nationally per Redfin data. 1.7%. At that rate, after 10 years, your $415,000 property is worth $500,000. That is $85,000 in appreciation against $120,000 in negative cash flow and carrying costs. You are behind before you even pay selling costs. And selling costs are not small. When you sell a rental property, you are looking at 6 to 10% in closing costs, realtor commissions, and transaction fees. On a $500,000 sale, that is $30,000 to $50,000 off the top. Then, if you have not lived in the property for 2 of the previous 5 years, which as an investor, you have not, you face capital gains taxes on your profits. And then there is depreciation recapture. Every year you own the rental, you took a depreciation deduction on your taxes. The IRS recaptures all of that when you sell at a rate of 25%. The tax tail on a rental property exit is genuinely brutal and almost never appears in the initial pitch. Here is the kicker. Even REITs, the publicly traded, passively owned real estate investment trusts that let you own a piece of thousands of properties through a single ticker symbol, returned 11.8% annually from 1972 to 2019, according to Morningstar data. 11.8% better than the S&P 500s. 10.6% in that same window. You could have gotten real estate exposure, rent-backed income, geographic diversification, and management by professionals with 0 phone calls about burst pipes by buying a REIT ETF. And you could have sold it in 14 seconds if you needed the money. The rental property is an illiquid, concentrated, actively managed bet on one specific address in one specific zip code, and you do not know how that zip code is going to perform. Marcus, by the way, found this out the hard way. Jacksonville, where he bought, was in the cohort of Sunbelt markets where prices declined in 2025. His $390,000 property appraised at $372,000 at the end of year 3. He was underwater on appreciation. His cash-on-cash return after actual documented expenses was negative. He was not building wealth. He was doing maintenance work for free while paying a bank to let him do it. Now here is the psychological layer that makes all of this worse, and this is the part that I find genuinely fascinating. Rental property taps into what behavioral economists call the tangibility bias. People feel better about investments they can physically touch. You can drive past your rental property, you can point at it, you can say, that is mine. You cannot drive past your index fund shares. They do not feel real in the same way. And because the asset feels real, you attach a cognitive story to it, the story of passive income, of legacy, of building something. That story is enormously compelling. It is also, for most people, empirically wrong. There is a second psychological dynamic, what researchers call overconfidence bias in personal skill. People consistently believe they will be better landlords than average. They will find better tenants, maintain lower vacancy, handle repairs more cheaply because they know a guy. And some do, but the math does not care about your confidence. The math cares about interest rates, market rents, vacancy trends, and unexpected expenses, none of which you control. The people who make money in rental real estate are generally those who bought before 2020 or who operate at scale with professional management and underwriting discipline. They are not the amateur individual investor buying their first rental in 2026 based on a YouTube video from 2019. And here's something that almost never gets discussed: the path dependence problem. If you buy a rental property and it starts losing money every month, exiting is painful and expensive. You cannot sell it in seconds like a stock. You have to list it, negotiate, wait through escrow, and absorb the transaction costs I mentioned. You are locked in. And the longer you stay locked into a losing position, the more the losses compound. The broken vending machine does not fix itself while you are waiting for the market to turn. Let me build out a concrete scenario now, because I want you to be able to replicate this math with any property you are considering. The property, a $420,000 single-family rental in a mid-sized US market. You put 20% down, which is $84,000. Your loan is $336,000. At today's investment property rate of 7.5% on a 30-year fixed, your monthly mortgage payment is $2,349. You find a tenant at $2,500 per month. That is the gross yield of approximately 7% of the purchase price annualized, which is above the national average gross yield of 6.56%. You are already doing better than average before you start. Now the real expenses: property taxes at 1.1%, $3,850 per year or $321 per month. Landlord insurance, $1,500 per year or $125 per month. Maintenance reserve at 1.5% of value, $6,300 per year or $525 per month. Vacancy allowance at 7%, $1,400 per year or $167 per month. Accounting fees, $600 per year or $50 per month. Total operating expenses, $14,650 per year or $1,221 per month. Take the rent, $2,500 per month, minus operating expenses, $1,221 equals net operating income before debt service, $1,279 per month. Now, subtract the mortgage, $2,349 per month. Monthly cash flow, negative $1,070. Annual cash loss, $12,840. And that is before property management fees if you decide to hire someone, typically 8 to 12% of monthly rent, which would add another $200 to $300 per month to your losses. before any major capital expenditure, before any legal fees, before your time. Now let me give you the opportunity cost comparison in the same time frame. Take that $84,000 down payment, put it in a broad market index fund at 10% per year. 10 years later, it is $218,000. No calls, no maintenance, no tenants. And take the $12,840 per year in negative cash flow, the money you were writing the bank every year, and imagine you had invested that monthly in the index fund instead. Roughly $1,070 per month at 10% annually over 10 years compounds to approximately $221,000. 218 plus 221, you are looking at over $439,000 in the index fund scenario. Against a rental property scenario where you need home appreciation just to break even on your losses, and where selling costs and taxes would eat a significant portion of whatever you gained, here's the part where someone says to me, "But Tom, you are not accounting for principal paydown. The tenant is paying down your mortgage." You are right. On a 30-year mortgage, in the first 10 years, you are paying mostly interest. Of roughly $28,000 per year in mortgage payments, roughly $23,000 is interest, and only about $5,000 is principal in the early years. So yes, the tenant is paying down the mortgage slowly, but they are primarily paying your bank's interest bill. You think the principal paydown is the saving grace, but actually, the amortization schedule means in year one, 90% of every mortgage payment is interest. You are essentially renting the loan from the bank. The broken vending machine, giving its money to a different machine. 3 things. Because if you are still watching at this point, you are not looking for permission to be lazy. You want the actual framework. Here it is. First, run honest numbers before you buy anything. Do not model the best case rent, the optimistic vacancy rate, and the low-end maintenance estimate. Model the median rent in your market, a 7% vacancy assumption based on current census data, and 1.5% annual maintenance. Then add your actual mortgage payment at current investment property rates, not the rate from someone's 2020 case study, and see if the number is green. In most markets right now, at current prices and current rates, it will not be green. That is important information. Do not ignore it. Second, if you are determined to get real estate exposure in your portfolio, compare REITs before you compare properties. You can own professionally managed real estate, diversified across hundreds of properties and geographies through a publicly traded fund with full liquidity and without ever being a landlord. The returns from 1972 to 2019 beat the S&P by over a full percentage point annually. The lazy portfolio I have written about does not ignore real estate. It holds it efficiently through instruments that do not call you at midnight. Third, account for your time. Every hour you spend managing a rental is an hour that is not doing something else. If you have a job, a business, a family, and you are the kind of person watching this channel, you probably have all 3. 94 hours per year per rental is not trivial. It is 2.5 weeks of your life annually doing work that you did not price when you ran the returns. Price it. If the math does not survive adding your time at a reasonable hourly rate, the investment is not passive income. It is a second job with a worse boss. Here's the part about Marcus that I did not tell you at the beginning. He is not destitute. He is not ruined. The property has real equity in it, and Jacksonville, despite the price dip, will probably appreciate over the long term. Real estate over very long time horizons, held for 20 or 30 years, tends to work out. The problem is not that real estate is inherently a terrible investment. The problem is the specific pitch, that buying a rental property in 2026, financed at current rates, with current prices, will generate passive income for the average individual investor. That pitch is false. It is empirically, mathematically false for most people in most markets under current conditions. And nobody in the industry has a financial incentive to tell you that. The accountants and the lawyers I have worked with over the past 10 plus years, the people who see the actual numbers, not the pitch decks, almost universally own their real estate differently than the way it is sold. They own index funds, some own REITs, a few own commercial properties at scale with professional management and underwriting teams. Almost none of them bought a single family rental with a 7.5% mortgage in a market where rents hit a ceiling and then told themselves it was passive income. Lazy investing built more fortune than crypto memes. And it built more fortune than most rental properties purchased in the last 3 years, if you actually run honest numbers with honest time assumptions and honest exit costs. The vending machine only works when the economics of the machine makes sense. Right now, for most Americans, in most markets, they do not. That might change. Rates might come down. Prices might correct. The math might flip positive again in certain markets. When it does, I will tell you. Until then, the most valuable thing you can do with your down payment is understand what it costs to put it in the wrong place. Here is where the exit code comes in, and I want to be straightforward about why. Knowing these numbers is one thing. Building a framework that connects them to an actual date, a specific month and year, when you can realistically exit the rat race, is something entirely different. I had access to the same data years ago. What I did not have was a system that translated the data into a plan. I built a digital book called The Exit Code. It is 8 chapters of research distilled from 50 years of retirement data, and I am not going to list every chapter because that is not the point. What I will tell you is this. 2 of the concepts in that book are directly relevant to what we just discussed. The first is the dynamic withdrawal method, a framework that replaces the 4% rule, which breaks down the moment you retire into a period of above average market volatility. The 4% rule was never designed as a strategy. It was a finding from a single paper, and most advisors apply it as if it is physics. It is not. The dynamic alternative uses a tiered adjustment system that has historically extended portfolio lifespans by years. The second is what I call the lazy portfolio, a specific allocation structure that has historically outperformed active traders over 30-year windows, including real estate investors who measured their returns honestly. It is not complicated, it is boring. That is the point. The exit code is available through the link in the description. It costs less than dinner for 2. Every year you wait on building the system compounds against you, not metaphorically, but mathematically, in ways that the final chapter makes explicit. And if the broken vending machine analogy is still running in your head, good. It should be. The first step to not buying a lemon is knowing what one sounds like.